Hi everyone, a very happy Saturday to everyone. I thought of making a video on another important topic, which is when to sell. I think it's also one of the very difficult topics in investing. One thing to keep in mind is that as with most of investing, it is a personal finance subject, meaning that what works for me might not work for other people and vice versa. And another similar saying being that one man's garbage can be another man's gold, right? So let's discuss like the 4 different situations in which I typically might end up selling a company. The first one I think is the easiest one to talk about. It is valuation, right? So another way to think about valuation is, if let's say I am buying a company at and just to give an example, and of course any of the companies I discuss in this video are not buy and sell recommendations. These are just examples from the past. So there's a company called Polymedicure, which during COVID times was available between 25 to 30 price to earning multiple. And if you look at its quarterly sales, they have been growing very consistently for as long as I think 15 years or something, right? So if you look at the top line and profit growth, so from 2004 to 2023, I mean maybe even 20 years, it has been around that 15% to 17% mark. So even though the growth is not a lot, but it's very consistent, right? What I was thinking is, this company, the consistency of its growth, and because they're in medical consumables, is actually as good as FMCGs, right? And at 25 to 30 times a medical consumable, it's basically a fast moving good, except that it's used in medical, where you don't have a discretionary spending but rather a forced spending, right? It probably shouldn't trade at 25 to 30 times earnings, was the entire thesis, right? And then some amount of growth keeps coming. The interesting thing is, from 25 to 30, over time it went to 80 to 90 times earnings, right? Now we can go to the past and look at history of companies and see how many sustain their valuations at 80 to 90 times price to earning multiple. What you'll find is not too many do, and that this is where the overarching theme you will find in all of these different sell decisions is risk reward. Exact same company, right? Nothing has changed, but because the PE moved up from 25-30 to 80-90, it becomes a sell, right? Not that the company did anything bad in execution and stuff. And I think even right now, if I look at it, let me quickly try Polymedicure. So I think even today it's at like 50 to 53 times earnings, and the price is probably like 10% more than where I had sold. I think I sold it like 2 years ago. So I think on XIR I'm doing pretty well because of the sell, right? Because the valuation was very high. It's not that the earnings have degrown. Earnings have grown, but the price has been sort of stable, and so the sort of price is catching up. I mean, the valuation is catching up. Let's go to the second reason to sell. Thesis breakdown. What this essentially means is, you had a certain thesis when you bought the company. That thesis is not playing out anymore, right? This is a very good reason to sell a company. Another way to think about it is, there was a certain expectation I had for how the company and its business would evolve. If those things are not happening anymore, it's a very good signal that probably we should find somewhere else where we have better ability to predict about the company. So many such examples exist. One is Laurus, another is Webhub Global, another is Newland. So one thing to keep in mind is that whenever we are selling and whenever we are buying, investment is a lot about the timing of the decision, for sure, because it's possible that what you thought might happen this year might happen 2 years later, right? So essentially there is that element of investors getting fatigued or sort of tired waiting for their thesis and selling out, and then it plays out after they sell, right? So if you look at Newland, for example, the precise thesis that investors had is playing out today essentially, right? But it's just that the numbers and the business is so lumpy, it's very hard to tell that this was going to happen all along, right? At the time of exhaustion, of course, the investors had waited for some time and the numbers were not coming. So then if you look at Vaibhav Global, the interesting thing which happened there is their growth rate, which used to be between 15 to 17% per year for the top line, and maybe like 20 to 25% for the bottom line. This actually went up to, I think, something like 25% for the top line and like 45 to 50% for the bottom line, right? The fascinating thing is Vaibhav Global's PE also went up to like 60 to 70 times. Now the thing is, with all of these things, investor had to be very careful and sure that this momentum would continue. The end market, which is the retail market in US, is probably not growing that fast, right? And even if you look at e-commerce or e-retail, even that is not growing that fast. The mistake that investors made, including me, is that we extrapolated the growth that was happening because of COVID and stay home as a secular trend, right? It did not end up being a secular trend. It was simply the fact that they were pulling forward their growth. So whatever they had to grow in the next 3 to 5 years, they probably did in 1 or 2 years, right? That's all that happened. And after that, because they were also making investments in Germany, so a lot of OPEX increased because of that, and then there was operating deleverage. So company like Vaibhav has operating leverage, but if the revenue does not grow, you have operating deleverage also, right? Similarly, if you look at Laurus Lab, the important thing that happened is, if you look at the ARV API prices and the competitive intensity, if you looked at the con calls of Aurobindo or SMS Pharma, you would figure out that basically there was a lot of increasing competition, lot of new DMFs being filed. That was happening. The second thing which was happening is that Paxlovid one-off existed in the earnings, and this was there in some of the brokerage reports, and our dear friend Ishmohit basically kept talking about this, and all we had to do as an investor is to sort of figure out, is this really happening or not, right? And if we had the opinion, and after checking the facts, that it is happening, then again it's a risk, right? Just to be clear, all of these calls of selling are not to say that the company will never do well. It's just to say that I don't see how the company does well in the next 1 year or 2 years, right? So as soon as the visibility goes away, thesis breakdown is the second reason to sell. The third thing is better opportunities. So one thing that has to be understood, especially for investors who might have other commitments, like they're running a business or they have a day job, is that they have limited amount of time, right? It is very difficult to track more than 14, 15 businesses, because to track them very well, you have to track their industry, you have to track their competitors, their clients, their suppliers, and the entire value chain and ecosystem, right? And so basically at any point, if the opportunity set has gone up, right? Think of it this way, there are 500 NSE 500 companies, and there are a total of 5,000 companies, right? And the dynamic economic landscape of the opportunities, that how much growth can they give, is always changing over time. So if the economic conditions are improving, if all these reforms which the government is doing are actually working, then what would end up happening is that the growth rates would start going up, and a lot of companies will start showing growth, right? For example, if you look at credit growth being very high, effectively who's the consumer of credit? It's either consumers or businesses, right? So either we are consuming more or businesses are producing more. Effectively, it means a lot of companies are showing a lot of growth, right? So the important thing to understand is, if I have a company which is promising to deliver 25 to 30% growth and it's priced at 50 times earnings, versus there is a company which is has a potential to deliver, let's say 50 to 70% growth, Actually, their guidance is more like 75 to 80% growth in the next 1 year, and it's at maybe 22 to 25 times price to earning. We have to weigh the relative opportunity cost of holding this versus holding this. It is not to say that the reward here is bad, right? I mean, in this case, this is Shivalik, and I still hold it, right? Because the competitive advantage and the moats are like very well established and very good. Whereas with these kind of companies, they are probably not that good and not that deep moats, essentially, right? Competitive advantages are not that high. So it has to be controlled through position sizing also, but capital allocation wise, I would probably not put more money here, right? So incremental money which is coming is not going to go here, it is going to go here, right? So automatically it is in a way sort of reducing this position size and increasing this position size. And essentially if the PE keeps going up, right, at some point it becomes a sell, right? At what point does it become a sell is subjective, and it will vary from person to person. So at 50 PE I might think, okay, it's justified, it has deep moats. But if this same 50 goes to 75 a few months later, I might not have the same thoughts, right? Because now the risk reward is even worse. The company has to grow even faster and for a higher period of time to justify these valuations, right? So I think it's important to have that risk reward mindset in all the places. So I want to now talk about the last type of selling. I think this is something which got added very recently, and these kind of things are definitely like a function of the market we are in, but I call them parabolic rises. Plus a little bit of valuation also. So the thing is, stocks represent part ownership of businesses, and they're supposed to discount the future possibilities and cash flows of the business, right? Imagine if a company is trading at 15 times earnings today and it doubles to 30 times earnings in a matter of 3 months, right? Of course, in 3 months, the earnings could not have doubled. They would probably not even have moved, might have grown like 5% or 10% quarter on quarter. But the price to earning has doubled, right? The risk reward is not the same. Typically, the stock chart for this looks like a parabola. It is going up and up all the time, right? Just think about, is this sustainable? Any new investor coming in will certainly not want to put a large amount of money or even buy these companies, right? So I think all of these also become very good candidates to at least trim just from a risk reward perspective, in my opinion, or even sell, depending on, of course, our conviction, our homework, what is the level of moats and competitive advantages, how confident are we that the company can actually keep growing, right? How lumpy is the business? All the qualitative things become very important here, right? So this has also happened a few times with me. So I thought it was very important to point this out. Companies like Focus, for example, and then Tina Rubber a while ago, all of these companies, and in fact I had posted to Twitter also that some caution is probably warranted in Focus, primarily because of this reason, that does it make any sense that the price is rising? So I think it's very important to keep these things in mind. If the price is rising too fast, too quickly, to me, unless I have a very good understanding of the competitive advantages, or unless the valuation is still cheap. Now one thing to understand is 15 to 30 is of course a different risk reward compared to 5 to 10. If you look at RACL went from 5 to 10 PE, right? I didn't sell a single share at 10 PE because I thought it was worth and sort of valued, it should be valued a lot more. So from 10 it went to 20, and now from 20 it has come to 30, right? Even today I don't think it is overvalued by any stretch of imagination, because their guidance is for 25 to 30% growth. They have very good moats, they work very closely with their clients, they have multi-year capex plans. They essentially think that there is a good visibility at least for 2 to 3 years, potentially even more time than that. Some of their clients like I forget the name now, but one of their clients is doing like a 7-8 year cycle where they want to sort of increase the components they source from India by I think 10x or something. So this is ZF. So ZF is the client which wants to increase their sourcing from India by I think 10x in the next 7-8 years. The point is there's very good visibility of growth, right? The PE and the relative risk reward is what one has to evaluate in this case. So 15 going to 30, very different risk reward. Even this has happened to me, 20 going to 40. This is also very different because the point is at 40 times earnings, you are pricing in a lot of execution, a lot of things going right? But if you are going from 5 PE to 10 PE, that's still cheap to me. And similar thing for Angel as well, right? Even when I had bought Angel, it was probably around 10 times earnings, it went to 20, then it went to 30. It's only when it went to, 27 to 30 times earnings, that's when I thought that, okay, now it's becoming a bit hard, and we had started seeing the first data of the growth sort of slowing down. That's when I had sort of sold it because of risk reward. So I think this parabolic rise is also something very important to keep in mind. And even I am sort of trying to see if there is a way to incorporate some of these learnings from price action guys. I don't believe too much in it, but I think it's important to at least keep an eye there. So yeah, these are the 4 things which I think are the good way to think of when to sell, and hope everyone has a good weekend. Take care. Bye.